Welcome back to Alpha Recap. It's Riley. Glad you could join us. We're looking back at a risk-off session that closed out January. And as always, if you have questions, you can reach us at stockalpha.ai.
Great to be here, Riley. Plenty to unpack from the last trading day of the month.
Let's start with the big picture. Markets closed down overall, but it wasn't uniform. The S&P 500 ETF finished down about 0.3%, while the Nasdaq-100 ETF dropped just over 1%. Small caps took it harder. The Russell 2000 ETF finished down about 1.4%. Jonathan, what felt different about this sell-off?
Two things stood out. First, it wasn't just tech weakness, although tech and semiconductors were a focal point. Second, commodity-linked trades and some pretty extreme moves in leveraged and inverse ETFs amplified the day. So you had a mix of classic risk-off selling plus headline-driven, sometimes acute, flows in niche corners of the market.
When you say commodities amplified things, give us a sense of how extreme it was.
It was wild. The large silver ETF plunged nearly 29% in the last trading day, while an inverse silver ETF jumped about 49%. A semiconductor bear ETF rose about 12.5%, and a leveraged inverse miners ETF climbed about 25%. Those are really big moves for single sessions, and they created a lot of volatility across related stocks and ETFs.
That sounds like more than normal rebalancing, almost like a structural dislocation. How do leveraged and inverse ETFs behave that can cause this kind of spike?
Good question. Leveraged and inverse ETFs try to deliver a multiple or the inverse of daily performance. That makes them path-dependent. Their returns depend on the day-to-day sequence of moves, not just where the underlying ends up. In a calm market, they can track well briefly, but in disorderly trading, especially in thinly traded products, you can see forced selling, margin calls, or concentration of flows that blow out prices. They're not long-term hedges unless you actively manage them.
So retail traders and even some funds can create cascades in those products.
Exactly. When volatility spikes, the mechanics of these ETFs can exaggerate moves. That led to both big winners and big losers yesterday.
Let's go sector by sector. Tech took heavy pain. Semiconductors were singled out. What was driving that?
Two threads. One, positioning ahead of the jobs report made investors less tolerant of cyclicality. Semiconductors are very cyclical. They're sensitive to demand and business cycles. Second, there was clear short-biased flow into semiconductor bear products, which signaled that large players were trimming or outright betting against chip exposure. That pressured not just smaller chip names, but also software and mega-cap tech that often correlate with the sector.
And small caps lagged. How do you interpret that in the context of risk appetite?
Small caps tend to be more economically sensitive. When investors get nervous about growth or tightening financial conditions, they reduce exposure to smaller companies first. A drop of about 1.4% in the Russell 2000 ETF is an early signal of risk-off behavior that can ripple into broader markets if confirmed by upcoming data.
Utilities and real estate were mixed. Was that just idiosyncratic or part of a defensive rotation?
A bit of both. Utilities sometimes attract defensive flows tied to rate moves, but we also saw individual volatility within the group. Real estate showed dispersion mostly because of deal activity. Transaction headlines can split performance across REITs, so it wasn't a clean defensive bid across the board.
Healthcare and financials were choppy too. Anything notable there?
Healthcare had pockets of strength on earnings beats, but it wasn't enough to counter broader weakness. Financials were mixed. Some deal-related headlines kept trading choppy. Overall, sectors that typically offer predictable cash flows did better relatively, which is what you'd expect when risk appetite wanes.
You mentioned cannabis names earlier. They were hit on legal headwinds. How big of a deal was that for the market?
The cannabis complex is more sentiment and policy-driven than fundamentals-driven for many names. Fresh regulatory or litigation headlines pushed investors to reduce exposure. While cannabis isn't a huge market cap weight, when you see a sector driven by news and headline risk, it can magnify intraday volatility and feed into the wider risk-off narrative.
Let's talk macro. The jobs report was front and center. Why did that create so much defensive repositioning?
Because the Fed is clearly data-dependent and labor is one of the most important inputs. If payrolls or wage growth come in hotter than expected, that reinforces a higher-for-longer interest rate outlook. Investors price that risk by trimming long, risky positions into the print. If the report is softer, you'd likely get relief. So the market was essentially holding its breath and de-risking.
You used the word binary earlier. Can you explain that simply for listeners?
Binary means there are two straightforward outcomes that matter a lot for markets. The data is stronger or the data is weaker. Stronger jobs data means more pressure on rates. That's bad for risk assets. Weaker data eases rate concerns and can trigger a bounce. Because the Federal Reserve has emphasized being data-driven, market moves around these releases are amplified.
Switching back to technicals, breadth was negative, and the Nasdaq underperformed the S&P. Why does that flag elevated risk aversion?
Tech often leads on the way up and amplifies moves on the way down. When the Nasdaq underperforms the S&P, it suggests the market is shedding its most aggressive exposures. Negative breadth with more decliners than advancers shows the sell-off was fairly broad rather than concentrated in a handful of names.
You also mentioned semiconductor shorts as a signal. For listeners who don't follow that closely, why watch that?
Because it reflects large players' views on demand for chips. If short-biased products in semiconductors spike, that's a proxy for expectations of weakening demand or inventory stress in the supply chain. Given how central semiconductors are to tech, it can be a leading indicator for broader tech weakness.
There were also some headline-grabbing microcap moves. One stock exploded thousands of %. Should retail listeners try to chase that?
No. Those moves are almost always driven by small floats, concentrated buying, potential promotional flows, or low liquidity. A microcap that surged over 3,000% is classic short-term speculation. For most investors and institutional players, chasing that is high risk and usually ends poorly without rigorous due diligence.
You gave a historical context in the piece, that the combination of a 1.2% drop in the Nasdaq and more than 1% in small caps can presage either a brief pullback or deeper correction. How should listeners interpret that?
Think of it like an early warning. Historically, sessions like that often occur around big macro releases or after commodity shocks. If the upcoming data, in this case the jobs report, eases concerns, the move can be a short-lived pullback. If data stays hawkish, you can see follow-through selling, so it's a cautionary setup rather than a definitive sell signal.
Okay, tactical takeaways. For someone listening who trades actively, what did you recommend?
Short-term, expect heightened volatility and consider reducing directional exposure into big macro releases. Hedge strategies or options can make sense if you need market exposure. For sector allocation, technology and small-cap exposures were most vulnerable. Defensive names with predictable earnings tended to outperform. And with commodity ETF dislocations, be very careful using leveraged or inverse products. They can move far more than the underlying commodity.
And for longer-term investors?
Longer-term investors should avoid overreacting to one day of volatility, but it's a good time to check risk tolerances and rebalance if positions have drifted. Watch liquidity in thinly traded ETFs, and don't let headline microcap fireworks lure you away from a disciplined plan.
Before we wrap, what are the key things to watch this week?
First and foremost, the jobs report. Payrolls and wage growth will be market movers. Second, semiconductor earnings and guidance could either confirm yesterday's weakness or stabilize the group. Third, keep an eye on commodity flows and the liquidity in related ETFs. If dislocations continue in silver or miners, that could influence inflation expectations. And lastly, any legal or deal headlines in cannabis and real estate could drive idiosyncratic moves.
All right, let's close with 3 quick takeaways for listeners to remember from today.
1. Yesterday was a risk-off repositioning ahead of the jobs report, with tech and small caps leading the sell-off. 2. Commodity-linked and leveraged ETFs amplified volatility. They can exaggerate moves and aren't substitute long-term hedges. 3. Manage risk actively. If you need to be in the market, consider hedges and pay attention to liquidity in thinly traded instruments.
Great summary. Thanks, Jonathan. That's our wrap for today. A reminder that markets closed lower as traders repositioned for one of the most important economic releases of the month. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you on the next Alpha Recap.